Thank you for carving out time and joining us on Retiring Well this week and putting your retirement planning a priority. We have 4 wonderful topics to talk about today that we believe is going to help you plan to retire well. First, we're going to talk about debt in retirement. What does that mean, and what are some of the things you can do about it if you have debt? Then we're going to talk about bear markets, those declining markets, those negative or red numbers on your statements. What is that? What are some of the timelines of that? And what are some of the positive things you can look forward to? Corporate profits. Boy, as a business owner, you want to make money. As an investor, you want to see that business make money as well. And finally, to wrap the show up, we're going to talk about avoiding retirement planning pitfalls. You're not going to want to miss that segment and so much more here on Retiring Well.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
I want to talk about debt, and specifically debt in retirement. So obviously not a fun topic when we talk about debt and owing money, right? And specifically though, you know, as you're entering retirement or in retirement, is debt a bad thing? Well, not necessarily. Not all debt is bad. So one of the ways that I start to look at debt is to simply say, okay, what is that debt costing me? What is the interest rate? You know, were you able to refinance your mortgage when rates were low? Or do you have a higher, maybe a more variable rate where it's starting to inch up as the interest rates rise? So what is that costing you? Now, take a look at that in comparison to what is your savings making you? So is your savings making more than your debt is costing? So that's a simple way. Now, it's not the end-all solution of looking at that, but it's a simple way to start looking at your debt. You know, do you know that the average baby boomer has just under $100,000 in debt? So you're not alone if you do have debt. But specifically, what is the plan for that debt? We have to obviously either pay for it in monthly installments, or we have to have a plan to pay it off. If we don't, bad things happen, right? There's a risk to having debt. Just like investing in various things, there's different risk, but when we look at debt, how is that risk not only to having a repossession or a foreclosure or something like that, but a risk to our cash flow? When we get into retirement, oftentimes you hear people talk about, I'm living on a fixed income or something along those lines. If you're fully retired and maybe have Social Security, pension, or having some sort of paycheck come off of your savings, you know, there's probably some sort of fixed aspect to that. So how is that budgetary number from those debt payments coming out of that? When we sit down with somebody here in our offices for the first time, you know, we like to gather lots of information before we make any recommendations. The important thing behind that is there's different things that people have going on in their lives. You know, debt is one of those things that we need to be taking a look at. What is the term? How much time is left? What is the balance owed? What is the monthly payments? And then what are those cash flows areas that you have to pay off those? Should we look at paying down stuff or accelerating that payoff? Should we look at taking some money from a savings or a 401k or the likes to pay it off early? What are the costs? There's maybe tax consequences to that. Are you getting deductions for having this debt? All these various things that pose around that. But if you're not having a debt conversation with your financial advisor and you have it, you might be missing something. So make sure when you're looking at this aspect of this and looking at your retirement planning, you're making sure you have that holistic look at this and having a plan so you can either make sure you're paying this debt and it's not costing you too much, or you have a plan in place to pay it down in advance.
Hey, welcome back from another great segment on debt in retirement. And the one takeaway that I had from that segment was that if you find yourself, you know, either near retirement or in retirement and you have some debt, hey, you're not alone. And that's comforting. But now the second thing is, what do we do about that? What are you doing about that? What is your plan for that debt in retirement? And yeah, I recently had a case in the Cadillac office where a client came in and they said, hey, you know, I had this variable loan out there. It was for some fun life expenses, and they had, you know, helped their daughters get married. And they said, well, this variable rate now is gone up significantly as interest rates have risen. And so we said, okay, no worries. Hey, we had a plan that we put in place to have some no market risk money available as distributions. And so what we did is we took some free withdrawals from this product that he had. He was able to pay down some of that debt and take away, those rising interest rates that were variable and deal with it that way. But it helped because there was a plan that we had put in place before these times. I know, Nick, you're in the Gaylord office, had another situation like that?
Yeah, I mean, the key word there, Jack, that you said is plan. Having that plan in place to tackle that debt is just so important. Like Jack was saying, I had a case in Gaylord where a couple had just retired and they had two different debts out there that were quite substantial. One was a credit card, the other was a tractor that they had purchased a couple years back. Now, with their case, it was more of, okay, let's plan on a way to pay this off, but let's tackle the debt that's costing them the most first. So for their case, the tractor was a zero interest rate, so it wasn't really costing them to pay that tractor off. However, the credit card had a large interest rate that they were paying on that. So of course we wanted to tackle that first. But the plan was, okay, not as soon as they retire because their income was high and we didn't want to take out too much and bump them up in the next tax bracket. So we determined the best plan of action was to pay that off over a couple of years. But like Jack was saying, and I'm saying as well, is having a plan in place to tackle that debt is so, so important. All right, coming up next, we're going to be talking about bear markets and corporate profits. You don't want to miss it.
If you like watching Retiring Well, make sure to go to youtube.com/retiringwell and click the subscribe button to never miss any of our TV shows and other informative videos.
The biggest concerns that clients have when they come to see us is usually the fear of the unknown. When they're heading into retirement, there is so many uncertainties that they're going to face, not only financially, but with time, with insurances, with taxes.
You figure you've got one chance to do it and you better do it right.
With that fear of unknown, they're looking for somebody to walk alongside them in this journey and to guide them along the way.
Retirement's like 20 to 30 years of unemployment, so you need to have a plan in place to generate that income.
We can help eliminate some of those unknowns and give them the confidence that they're going to be able to succeed in the goals they want to do in retirement.
We want you to have your finances in order so that that's more of an afterthought, more of something that you say, well, that's what our team at Centennial Wealth Advisory is there to take care of.
Too often, our industry focuses on the tools that are available in mutual funds and stocks and bonds, and oftentimes the industry wants to start with a product. We believe here that you should focus on the individual's goals first. What do you want to do in retirement? What does that look like to you? Then what strategies do we need to implement to make those goals become a reality?
So often we find that our clients love spending time with their family, with their grandchildren. Here in northern Michigan, people love to be outside and enjoy kayaking or biking or hiking in the warmer months, sometimes in the winter months as well, out snowshoeing. Our hope at Centennial Wealth Advisory is to help you open up those opportunities to go and enjoy your retirement.
As a financial advisor, it's not just my job to manage just your money. It's my job to understand who you are as a person, your personal relationships, your aspirations and goals, and so I can help create a plan that ties your financial future with your personal future and all those goals.
You want to retire, you get one opportunity to retire, and you want to do it right the first time. Our role here at Centennial Wealth Advisory is to help walk you through that entire process and ultimately help you plan to retire well.
You've probably heard all the Wall Street pundits talk about bear markets versus bull markets. Well, let's share a little bit more about the bear markets and ultimately how you see a decline of 20% or more in any of the major stock indices. So it's obviously the opposite of a bull market, which is a positive 20% or more. And we saw in 2022 both the NASDAQ and the S&P 500 experience those pullbacks, experience what we would look at as a bear market. And on average, we experience a bear market every 3.5 years or so. And the typical characteristics of a bear market include this 20% or more sustained decline. So it needs to be staying below that threshold. And you also are typically experiencing like an economic decline. So with that, you'll typically see higher unemployment. You might see low GDP, which might then, if you have two negative quarters of GDP, that's what leads to a recession, and declining corporate profits. So there's also going to be negative sentiment in the investment world. So there's going to be those investors that are very pessimistic about what direction they think the stock market's going next. And lastly, the duration. Decline must be for at least 2 months, and then on average you'd see with bear markets the decline occur under that 20% threshold for on average about 10 months that you'd experience the bear market. Now, maybe some different ideas to be considering when experiencing a bear market. First would be diversification. So this not just factors in like your stocks and bonds, but what about are you looking at different real estate types of investments? Have you considered different types of insurance products? What about your cash, money market, CDs? So again, having a diverse blend, not solely dependent on what the stock market's doing. And you should be focusing on those long-term goals. You know, selling low may not be the best plan for you depending on where you are. And if you're looking at getting invested, what about that dollar cost averaging where you're not necessarily going to be timing the market when you buy in, so instead you're going to be doing that at regular intervals, investing into the market. And lastly, maybe adjusting your asset allocation. You know, ultimately your goals may change over time, and prior to retirement may look very different to you than in retirement. So the last idea I'd share with you is ultimately talk to a financial advisor. Here at Centennial Wealth Advisory, our hope is to sit down with you and build an overall plan that's not just looking strictly at the investments, but also factor in income and taxes and estate planning and insurance planning, and ultimately help you plan to retire well.
Living life isn't always easy. It puts up challenges and obstacles you'll have to overcome. There are responsibilities. You put in effort to provide and take care of your family, to save and invest, to balance work and life. Planning is the first step to succeeding. Plan to retire well.
Let's talk about profits, and specifically corporate profits. You know, we often hear, if you're watching some of the financial shows or news stations, and they talk about earnings seasons and companies are reporting their earnings and all of this. And maybe you're sitting there and, well, what is that? Or why is that important to me? You know, as consumers, you and I, we don't really want corporate profits. We want to get a deal, right? We want to walk in and we buy the stuff as the best deal we can and get it at a low price. And we don't care if those businesses make money or not off our transaction because we're getting a deal, right? But as an investor, we want corporate profits. You know, we're an investor in these businesses. If you're buying stock or anything like that, you know, we want these companies to have profits because we want our investments to grow, right? Let's scale it down real simple. Let's say you own a small business. Let's pick anything, an ice cream shop, right? You buy goods, you buy materials to serve up your ice cream cones. Well, you have to make a profit on that, right? So you want a bigger profit so you can put more money in your pocket. Maybe you want to hire staff. Maybe you want to expand, stuff like that. You need profits to have a successful business to do this. Just like when we're investing, we want these corporations to be profitable. Now, what can a corporation do with profits? Well, they can reinvest it back in the business, right? They can hire more people, build new locations, expand research and development, all of that sort of stuff. They can buy inventories, they can increase their goods, right? Or they can maybe pay dividends and they can give it back to shareholders and investors. So again, we want to see profits from these businesses so we can do that. Now, oftentimes you hear them talk about forecasting or looking ahead. So they're then taking what they know they've done in the past, what they're looking at maybe from a cycle or marketing that they have going on and looking ahead to see maybe what their forward-looking profits are going to be. And so that may lead investors to want to invest or want to sell their investments because maybe that company isn't going to be so profitable. So again, why are we talking about this today? Well, if you have a 401k, an IRA, or any investment, you want to see the companies that you are invested in as profitable in there. Oftentimes people say, well, I don't even know what I'm invested in. That's a problem. You should know. You should be educated and understand what you have and why it's in there and how is that meeting your goals. So for you out there, and if you're an investor, you're coming into retirement or already early retired, we'd love to sit down and talk to you. Why not give yourself a chance to meet with us with our free no obligation visit, and we can walk through these things. We can walk through your individual investments and talk about how they relate to you and talk about these underlying things. Are they doing well or are they not? And if they're not, what adjustments can you make to your portfolio to make sure you're better aligned so you can plan to retire well?
What a very timely topic there to talk about bear markets. Currently, we obviously find ourselves in that situation there, and recently when I'm meeting with clients, the question is, okay, we're in a bear market, my portfolio's down X, can I really still retire in the next couple months like we had talked about? The important thing to remember is to always have a plan in place for different stages of the market. In regards to this couple out of the Petoskey office, I've been meeting with them for years, planning for this time for them to retire. Now, fortunately for them, we had set aside a certain portion of money where they were, instead of contributing to their current 401k, they were taking that money and putting it into their banking account for savings so that they had cash on hand, not only if a bear market like we find ourselves would come along, but also for health insurance planning. So there was a couple different aspects that we were planning for in doing that cash withdrawals basically from their paycheck instead of the 401k. So it's just so important to make sure that you're sitting down, meeting with somebody, helping you plan for these different situations that can come up as you approach retirement or in retirement. And I know, Jack, you have a similar situation there in the Cadillac office as well.
Yeah, absolutely. Nick, that's a great point in that the planning is the best way to approach bear markets because, on average, they happen every 4.5 years. And so if you're 4.5 years away from retirement, you want to think about that. Hey, maybe you're 4.5 years away from your RMD. What happens if your RMD happens during a bear market? Do you want to sell your market risk funds at a loss in order to raise your RMD? Recently in the Cadillac office, we were mapping this out and we said, hey, we're going to project what your RMD is going to be. Oh, it's $30,000. Okay, what investment strategy are we going to put in place so that we can remove the market risk from the RMD requirement? Hey, if you're sitting there and you're unsure about what your plan is, please feel free to give us a call. We love to teach. We love to arm you with helpful information that'll help you plan to retire well. Stay tuned. Coming up next, we're going to be talking about how to avoid retirement planning pitfalls. Stay tuned.
culture in our office is phenomenal. We empower our team to be problem solvers. Oftentimes in this industry, things are going to change. So our team is empowered here to make decisions and to be able to problem solve for you. We have a lot of fun at the office, and we're a close group. When you call here, you get a person, and that culture shines through.
Relationships are so key when it comes to anything in life, and so here at Centennial Wealth Advisory, we focus a lot on team approach. We've started the Centennial Wealth Health Club.
We go down to the beach, we play some beach volleyball, some cornhole. Great time to just get together, relax with the team, but also get a little competitive as well.
It opens up those relationships to really get to know each other well. Building trust, the best definition that we've heard is consistency over time, and that's something that initially you can't get with a first meeting with someone, but as time evolves and our clients are working with us, they not only experience that with the financial advisory team, but also our tax team and health insurance team that all work together to ensure that they have a lifelong plan that they can count on.
It's a neat culture here in a small office. You don't necessarily have a lot of that corporate overhead. If we have a client who wants certain services, we can certainly offer those services, but go above and beyond with some of the other things that we do.
Confidence is something hard to put a price tag on. Finances don't just end with finances. Finances flow over into relationships, into daily emotions. And so when you can teach and you can get them to understand and they can find that confidence and you bring them to that, that's so rewarding.
I do think that what we're doing here is important. A lot of people think that they're fine, but they've never really looked into it. So if people can do more to be able to help themselves, live a more fun and enjoyable retirement, but also to be able to take care of themselves, then it benefits the whole community.
If you like watching Retiring Well, make sure to go to youtube.com/retiringwell and click the subscribe button to never miss any of our TV shows and other informative videos.
I'd like to share with you some potential retirement planning pitfalls and how to avoid those. So starting off, let's talk about not having any type of review process. Is it something where you essentially have these different retirement accounts and you've never really maybe sat down with an advisor to work through those and then periodically review all that information? Because as you can imagine, your life circumstances change and the ongoing market is going to be changing as well. So you want to be having some type of review process in place. What about lack of diversification? Are you structured in a portfolio where maybe you worked for a certain company and you really like that company's stock, and so you have a heavy percentage of your portfolio in that stock? Well, that's, as any advisor will tell you, it's encouraged to have a greater diversification, so that way if something were to happen to that particular company, then you have other assets to help mitigate that risk. What about underperforming assets? Have you looked at different holdings over time that you say, well, this isn't really living up to what the goals are that we established, and then maybe it's time to make a change. Even if that position is down at the time, you might say, well, it's best to sell that and move on to some other type of investment. What about psychological blocks? That might be the fear of the future of the market. You might be sitting there, I've talked to several people that have said, well, I just don't feel comfortable with the market right now, but then they think about it and they said, well, I've been saying the same thing for maybe the past several years. So that might be it, or it might be on the opposite end, the fear of missing out. Maybe you're in a position where you say, well, what if that market takes off? I don't want to miss out on that. So again, I would say it comes back to your comfort level with risk and matching up appropriately. A misconception of longevity. How long do you think you're going to live? I don't want you to just predetermine that based on, well, my family they only lived a short amount of time, but you might be perfectly healthy and might be expecting a longer lifetime. Another area is relying too heavily on your Social Security and or maybe ignoring your Social Security. That can be a vital piece of your overall retirement income plan, and want you to be looking at that as far as should you be starting at 62 or perhaps delaying till 70. There's a lot of years in there to evaluate. Another area might be thinking that you're going to work indefinitely. Have a plan for if you were to retire perhaps at a younger age than you may think that you're working, just to make sure that you're in a good spot. Last one is going to be ignoring tax implications. I think too often people aren't really factoring into their retirement plan what the taxes are on their portfolio, especially when they start to take income. So all of these are major pitfalls and areas that we encourage you to create a plan, and that's where we'd love to sit down with you and help you plan to retire well.
Hey, welcome back. What a great segment on how you can avoid some planning pitfalls. I know personally, if there's something in my life that is either going to take a lot of thought, maybe it's fearful for me to enter into those discussions, maybe I don't know how to figure it out, I don't know where to turn, I tend to procrastinate. And what we find here at Centennial Wealth Advisory is that I'm not alone. You do that also, you know, and we see people all the time that will come into our office and they'll say, you know, we waited so long because we thought you worked with higher end clientele and that we weren't a fit, or you know, we really wanted a second opinion but we didn't know who we could trust. Hey, we're just normal people that love to help and we love to teach. That's sincere. We love that we can do reviews during those first meetings to say, hey, you're good on your income plan, you're good on your investment strategy, you have some problems with your tax planning, I don't know what your health care plan situation is going to be, and oh, by the way, hey, your estate plan, your legacy plan is not in good order. You know, when we can bring that to clients, they might just have one or two or a couple takeaways, but either way, we get to help teach and we get to help them figure out what's good and what's not. And that's the most enjoyable thing that we get to do here at Centennial Wealth Advisory. So if you're sitting there and you're like, hey, let's just go have a first meeting, you will never get pressure, and let's just learn, let's get a red flag review of our portfolio and our strategies, have a holistic approach, you know, that Centennial takes, have them review what we have. You know, Nick, I know you in the Petoskey office have the same situations?
Yeah, I mean, it's the same thing. So when I meet with you first, I'll just go over a typical first meeting, okay? We're going to sit down, and I'm actually going to turn that meeting over to you. I'm going to ask what your story is, what your goals are, who you are. That's where we're going to start. We're not going to start with dropping your statements on the table and going over how much money you have saved. I want to know about you first, and then we'll go from there and develop a plan, touch on all those different topics, whether it's tax planning, investment planning, health insurance planning, estate planning, all of that. But it all starts with you first, hearing your story, and going from there. So hopefully you found this show valuable. Please don't forget to check us out online as well. You can go to YouTube/Retiring Well. Lots of episodes are out there for you to check out. Lots of great information. So, but we'll be again back here next week. Same channel, same station. Don't forget to come back.